Okay, good afternoon and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at Options Play. And today we're going to be covering option strategies for bearish markets. And it might seem a little silly to be covering this topic as we kind of make new all-time highs on the equity markets. However, many times it's actually when we make new all-time highs and pushing new all-time highs, do we potentially have the need to take sometimes a bearish position, whether that's a overall bearish position for the markets or a bearish position for an individual security. What we want to make sure that you understand is if and when you do have a bearish view on the overall markets, how do you structure that using options, and how do you find ideas that take advantage of a market that's moving lower? So let's go ahead and get started. What we are going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities that we'll be using as example purposes during today's session. So we'll cover just a general equity market outlook quickly to give you an understanding of where we currently stand from equities and our expectations going forward. We'll take a look at a bearish trade timing perspective, kind of the things that you typically look for to time a bearish opportunity. Then we'll cover the basic option strategies that make sense for a bearish outlook. And then we'll look at a couple of bearish trade examples. And then I think the most important thing here is to show you some of the idea generation tools that are available to you here at First Trade with the options by partnership that can help you identify candidates that are suitable for a bearish trade. And then we'll open this up for Q&A here at the very end. But the primary thing that I want you to be able to walk away from today's session is a clear understanding as to how can you leverage options to take bearish opportunities in this market. So let's start off by taking a look at equities. Now, I put together these slides yesterday before the CPI print this morning. So with CPI print and retail sales coming in, CPI coming in line with expectations, and retail sales coming in cooler than expectations, it really keeps the door open for a rate cut, probably by the September meeting for the Fed. The Fed likely will need to see a couple of more readings before they have the confidence to start cutting rates, and that kind of puts us into the September camp. Bond markets are currently pricing in about a 60% probability of the first rate cut in September and another rate cut currently in December. So that is the consensus right now from the markets. And on the back of this morning's news, we saw equity markets rally to new all-time highs. The one thing I do want to point out here is that as we make new all-time highs, momentum so far has not confirmed those new highs. So this is showing some level of exhaustion here on buyers, where momentum has not confirmed the move higher here at the moment. So my outlook here for equities is a little bit more cautious, despite the fact that we made a new 52-week high. I think a pullback into the trading range that we have been in between 5,000 and 5,250 is very likely, despite the fact that we've broken out to a new all-time high. I think trading back into that range is very likely before it continues moving higher, especially if you look at kind of what sectors are leading, what sectors are lagging behind. Technology, discretionary are still lagging behind, while financials, utilities, the staples, the defensive sectors are the ones that are leading at the moment. So given those kind of indicators, I'm still much more cautious here on the equity markets at the moment, which leads us to potentially looking at some bearish opportunities. You also see the VIX continue to trade relatively low in that 13% range, 13.5 range, which gives us the opportunity to be long volatility. So buying options at the moment is potentially slightly more favorable than selling options. But we'll take a look at a few different option strategies that can straddle both buying and selling options to take advantage of any bearish opportunities here in the broader markets. So let's talk a little bit about bearish trade, because you can think of bearish trades as kind of a mirror image of bullish trades, but it's not quite exactly the same, because when we think about bearish trades, the markets move lower 40% of the time and move higher 60% of the time. So statistically speaking, right off the bat, you're at a disadvantage whenever you're taking a bearish position. They don't move lower, or the market moves higher more often than it does move lower. So you have to factor that into your decision as to when you might want to take a bearish opportunity. The one thing is that when markets move lower, they tend to move lower faster than when they move higher. So a few things to consider when you're thinking about bearish trades. Number one, you want to make sure that you have the risk reward as favorable as possible. And what that means is that you have to wait for rallies in order to enter a bearish position. You basically want to enter at the highest possible point in order to take advantage of the largest possible move here to the downside. If you wait for the stock to break down and then enter, that's when the risk reward is least favorable to you. So you have to wait for rallies and look for those sell-offs on the back of those rallies. And you can use technical indicators to determine when something is overbought in order to enter that selling strategy, and always turn to prior support that has turned into new resistance to provide potential entries for shorts as well. So for example, if you look at the chart here, when the stock rallies back to prior support, that is your potential opportunity to be a seller or to enter that specific trade. So it's really important from a bearish trade perspective that you don't just think about it as a mirror image of bullish trades, but you really have to think about the statistics and how it's effectively weighed against you in your decision-making process as to whether or not a bearish strategy makes sense. So what type of strategies are suitable for volatile markets when things are selling off? Generally speaking, option selling has an advantage in high volatility environments. So we'll take a look at some of those strategies, but you will find that there are some opportunities or some scenarios where you would prefer to be buying an option despite the fact that volatility is high. We'll talk about that here in a second. When we talk about bearish opportunities, because they tend to last, they tend to be faster and more violent, and simply last for shorter amounts of time than bull markets. Shorter dated options will reduce the time horizon on the trade. It will also provide higher amounts of leverage and higher amounts of acceleration if the trade does work in your favor. So whenever you're looking at bearish opportunities, we tend to adjust our expiration dates slightly shorter than when we're looking at bullish opportunities for those reasons. And trading spreads, meaning trading vertical spreads, trading butterflies, condors, those types of strategies will help offset some of the costs from buying options and reduce the overall risk for selling options. So whether you're a buyer or a seller, spreads can help you either lower your risk, lower your margin requirements, and potentially amplify your potential returns when you are right on a given trade. So whenever you're thinking about these bearish opportunities, think beyond single leg. Instead of just buying a put, look at buying a put spread. Instead of selling a call, look at selling a call spread. These will help reduce your overall risk and improve your return profile when it comes to when you're closing out the trade. And then lastly, think about when you have the opportunity to scale in and out of the trades instead of being all out or all in or all out. Many times, you might find that it's hard to time a trade exactly. So instead of trying to be all in and all out and time the trades perfectly, sometimes it's just better to establish a small position when you initially feel that the stock is going to decline. And if the stock does decline, that is an opportunity for you to add further exposure and add to the position sizing. And it gives you that flexibility to scale into the trade slowly and potentially scale out of the trade slowly as well. So those are some of the tips that I have with regards to thinking about the option strategy structure to bearish opportunities in the market. So let's talk a little bit about finding bearish trade ideas, because in options play, we have tools that can help you identify bearish trades. And that's the technical ideas that I'm going to show you here in 1 second. Within options play, when you use the options play platform, there's an idea section in the upper right. Within the idea section, there's a technical ideas section that will provide you with stocks that are currently exhibiting, as I said, rallies in a bearish trend. So meaning the risk reward is as favorable as possible in your favor to take a look at bearish opportunities. So we'll take a look at that here using the options play platform. So in order to utilize the options play platform in your first trade account, you'll see the options wizard here. If you go to your home screen, you will also see it if you go to your options trading tab. Within the options trading tab, you will also see the options wizard here on the upper right hand corner or on the right hand side. And when you click on that, that will bring up the options play platform. The platform has a lot of different tools built into it from an idea generation perspective, from an option strategy structuring perspective. But today what we'll do is we'll look at both the technical ideas that the platform scans for on a nightly basis, as well as some of the trade opportunities that the platform scans for in the overall markets. So like I said, under the idea section, the first thing you will find is technical ideas. So these are screens that are based on the underlying security. And I always like to filter this based on what I'm looking for. So if let's say I feel that the markets have rallied up to a potential turning point, and I think that there's a possibility for markets to reverse lower, I can select looking at only bearish opportunities. And generally, I like to look at removing stocks that are not very liquid, because since I'm trading options on these, I don't want to look at stocks that aren't very liquid where I wouldn't be able to execute an options trade on it. As you can see, I have 13 ideas that are left. If I remove somewhat liquid, that'll get me down to 8. So usually I'll look at either very liquid or somewhat liquid ideas for bearish opportunities. And what it does is it'll sort it for me based on symbol, but I usually like to sort it based on relative strength. And what this tells me are which stocks are the strongest stocks that are starting to turn lower, and what are stocks that are some of the weakest stocks that are continuing lower. And I usually start my research on stocks that are strongest, meaning these are stocks that are just starting to turn bearish. So what I'm trying to do is trying to capture these as early as possible in their bearish trend. So Estee Lauder, as you can see, this is a stock that has largely been range bound between, call it 140 and 160 for the past few months. It recently broke below this support level and now has kind of come back to retest that level as resistance. So that's what I'm looking for, is a stock that has recently started a bearish trend. It has rallied a little bit recently, currently to a resistance level, and the risk reward for a bearish trade here is quite favorable. And this screening tool and options play helps me find these ideas without me having to plug in all these different symbols into my charts, looking at individual charts, seeing if there's an opportunity. This tool screens those opportunities for me. And then what I can do is I can quickly structure, if I like this trade, structure a bearish strategy on the back of that. So under the trade button, as you can see, it already defaults the bearish strategies because I've selected a bearish trade idea, and it presents 3 different bearish strategies that I can potentially trade on the back of that. I can also potentially use high implied volatility strategies, which will also give me a bearish idea here on the right-hand side. So regardless of whether my preference is to buy options or to sell options, I have multiple trades that I can easily pick from that will give me the bearish exposure I'm looking for, whether I'm looking to buy a put or a put spread, or if I'm looking to be a seller of options, selling a call spread. These are all strategies that have already been pre-selected for me with expiration dates and strike prices pre-selected for me so that I can just simply look at these strategies, look at the risk reward, and decide whether it's a trade that's suitable for me. If it is, I can click on the trade button, preview order, and that will actually pre-fill your order ticket at first trade. Let me see what happened here. Let's go back to Estee Lauder. Click on trade, click on preview order button, and I'm not sure why that didn't fill in for me. But this should pre-fill your order ticket for you. Let's see, let me try the single leg trade here. Trade, preview order. And as you can see, it pre-fills the order ticket for me with the expiration date and strike price already pre-filled, so that I can simply click on a limit order, type in a price, such as the bid price or ask price, or put in a mid price, and be able to send this order off for execution. And the goal is to help you find an idea, structure a trade, and be able to click with a single mouse, send that trade off for execution. As you can see, I never have to pull up an options chain. I don't have to figure out what strategy I want to trade. I don't have to figure out expiration dates and strike prices. It automatically does all of that work for me and structures an optimized trade for a bearish outlook once I find a bearish stock like Estee Lauder. So our platform will help you find these bearish opportunities in terms of bearish stocks. Once you've found a bearish stock, you can review the charts to make sure that you agree with the bearish outlook. And once you find a stock that you like from a bearish outlook perspective, here's Ross Stores. As you can see, it's been in a bearish trend for a couple of months now, but recently it rallied a little bit back to a prior resistance. And that is an opportunity where the risk to reward is more favorable for a continuation lower. And then if I agree with it, I can easily structure a trade here on the right. Click on the trade button, preview order, and that should pre-fill my order ticket for me. I have to figure out why the spread is not working here, but this is meant to help make your trading process as easy as possible so that you find an idea and structure it and you're able to execute a trade using your options play platform. So that covers kind of your, how we help you find bearish ideas. Now let's take a look at, once you find an idea, what are the different option strategies you can take to potentially profit from that bearish idea? And we're going to cover two strategies during today's session. We're going to look at a credit spread and we're going to look at a debit spread. So let's look at credit spreads first. So in this Estee Lauder example, after the stock broke below this 140 support level and it's rallied back up to that level as resistance, where the opportunity here is to the downside. If I were to sell a call vertical, which is a credit spread, the ideal structure for this is to go out roughly 45 days to expiration, which for Estee Lauder, which for right now would be the June 28th weekly expiration. And what you generally want to do is you want to sell an at the money call, which is roughly 50 deltas. That's a 135 call option when the stock's trading at 134. And what you want to do is you want to buy a 25 delta call or put against that to offset the overall risk of this trade. So I'm selling the 135, buying the 145 calls in this particular case. So that's a debit spread, a credit spread that's $10 wide. And for that, I'm going to collect roughly $3.57 or $357 per contract. And whenever you're trading a vertical spread, whatever you can potentially make on a trade, the rest of it will be your overall risk. So on a $10 wide credit spread, if I can potentially make $357 or $3.57, then my total risk is going to be the remaining dollar amount of the $10 vertical width. So in this particular case, that would be $6.43 or $643 per contract. Now, this does have a negative risk reward ratio, but this is a strategy that has a relatively high probability of profit. As you can see, it's got a 63% probability of profit. So greater than 50% chance of being profitable on this trade. And with any trade where the probability of profit is greater than 50%, your risk reward is generally going to be negative, meaning you're going to have to risk more to make less in this particular case. But in order to risk $643, the stock has to rally above 145 by expiration in order for that to happen. So that means the stock would have to basically get back above 145 in order for that to happen. As long as the stock stays where it is or moves lower, you'll make the full $357 profit in this particular case. Now, this is a very popular strategy because it's very forgiving. It has a high probability of profit. If it moves in the direction, you make the full $357 profit. But even if the stock doesn't move, even if it just stays around 134, you still make the full $357 profit at expiration. And that's the beauty of these types of option selling strategies, is that even if the stock doesn't move, you can still potentially make the full profit potential. Even if the stock rallies, you can still make money. So if the stock rallies up to 135, you still make the full $357. As long as it stays below your short strike of 135, you will make $357. So it's a very forgiving strategy. It's a strategy that gives you profits in many different scenarios. Only if the stock moves substantially against you do you risk the $643 in this particular case. So very popular strategy amongst traders that are looking to seek some bearish exposure. The other strategy that you can use is a debit spread. This is more kind of in the hedging and more tactical strategy where you believe that the stock is going to decline. You want to be able to profit from that decline. You might want to consider looking for a debit spread. This is really when you're buying a put option and you're turning into a spread to reduce the overall cost of the trade. So when we're trading debit spreads, we generally like to go out a little further in expiration because you are long an option. And whenever you're long options, time decay works against you. So by buying a little longer dated option, the time decay that you pay per day is actually less. The longer the option is from the further the option is from expiration, the less you pay in time decay per day. So that's why we typically go out a little longer whenever we're buying options to reduce that time decay factor. But we can also sell in this particular case, instead of just outright buying the at the money put, which is the 135 put, we're also going to sell a 120 put against that. And that's going to collect some premium. That's going to reduce my overall risk. It's going to also amplify my potential returns if the directional view is correct. And what you notice here with the debit spread is that your potential risk, $510, is far lower. Sorry, this is reversed. My max reward, I apologize, there's a typo here. My max reward is $990 versus my max risk is only $510, meaning I'm risking nearly half is what I can potentially make. And now a lot of people look at that kind of risk reward ratio and they'll say that makes a lot more sense to me. I want to risk $500 to potentially make $1,000. But I think it's important always to understand that stocks or strategies with good risk reward ratios also have poor probability of profit. Because in this particular example, my break-even price is effectively $129.90. Let's just call it 130 as a nice round number. So the stock has to decline to 130 just to break even, meaning the stock has to be below 130 in order for me to turn a profit. So if the stock stays where it is, or let's say it declines by only a couple of bucks, I'm going to lose the $510 in this particular example. Meaning, if the stock doesn't make a big move to the downside, I'm going to see some losses. And in exchange for that strong risk reward ratio, I'm generally going to have a lower probability of success. But when the stock does make that big move, I'm able to capture a return that's nearly twice what I'm risking in this particular example. So debit and credit spreads different from each other, utilizing different outlooks depending on whether you're neutral or you believe that a stock is going to make a big move. Make the choice between these two strategies to help you understand which strategy you might deploy in a bearish outlook for an underlying stock or ETF. And then what I wanted to show you is what we call our credit spread opportunity report, because if you think about a bearish opportunity, like I said, your best shot at being profitable on a bearish trade is to be patient and wait for a rally in an overall bearish trend, right? So if you look at a stock that's in an overall bearish trend, you want to be patient and wait for these rallies, because those rallies provide you with the best risk to reward of a move here to the downside. You want to be able to enter these trades near the top and exit near the bottom, right? And the only way to do that is to be patient and wait for these overall rallies. The other thing that you want to make sure is that you have an optimal trade structure from an options perspective. And then the last thing you want to make sure you have is are stocks that are liquid, so that stocks that you can easily execute an option strategy on the back of it. So we created our options play credit spread opportunity report to effectively find you stocks that meet all of these different criteria. First and foremost, we only find you credit spreads where you are collecting more than 1/3 of the vertical width. And what that translates to is making sure that your risk to reward on the credit spread is never worse than 2-to-1. That should be the absolute worst acceptable risk to reward ratio on a trade whenever you're selling a credit spread. Number two, we're looking at very liquid underlying symbols only, which means that you should be able to execute these trades at the midpoint, or at worst, a couple of pennies off of the midpoint. You know you'll be able to execute these because these are very liquid optionable symbols. And number three, what we're trying to make sure is that not only do we find you a good credit spread, that they're liquid, but we also make sure that the timing works best, meaning we wait for those rallies, we're patient on those rallies, and only when all three things are aligned do we generate a signal for you to sell a credit spread. And this you can find on the Options Play platform also under the idea section, but instead of looking at technical ideas, you would look at credit spread ideas. So let me just show that to you in 1 second. If you go to your ideas section, you click on credit spreads. When you click on it, it will bring you a list of stocks that are currently showing credit spreads that are suitable. And what you can do is you can filter them based on just bearish ideas. And that will now only show you bearish credit spreads. So let's say we look at JB Hunt, a transport stock. Well, you know what? Let's take a look at Adobe. Just because Adobe is a household name that most of you are familiar with, rather than JB Hunt, which I think are names that not everyone is as familiar with, right? So what we're looking for are kind of rallies, small rallies that you can take advantage of a potential move here to the downside. And what it does is it structures it for you so you know exactly what expiration date, what strike price, and our platform gives you the full risk to reward metrics so that you can quickly understand how much are you risking, how much can you potentially make before you go ahead and execute a trade on your account. And you might say to yourself, well, Adobe is a very high price stock. I'm not willing to risk $2,477 per contract on this trade. And if that's the case, you simply move on to the next idea. JB Hunt is only trading at JB Hunt is trading at around $170. Perhaps that's a lot more suitable for you. As you can see now, instead of risking $2,400, you're only risking $305. So what we're trying to do is find stocks that are, where from a technical perspective, you've got the bearish trend, but it recently rallied back up to that resistance, and you think that the risk reward or the risk reward is as favorable as possible, skewed in your favor. JB Hunt certainly meets that criteria. It's also a stock that's very liquid, so that you know that you can execute option strategies on these fairly easily. And what we've done is we've structured the trade structure for you. The June 21st 170, 175 call vertical. That's going to give you a potential reward of roughly $200 while you're risking, in this particular case, only $300. So a risk reward of only 1.5 to 1 with a probability of profit of about 64%. So you have a risk reward ratio that's quite favorable given the profit potential or the probability potential on this particular trade, and you can send this trade off for execution without having to do any further research. What we've done is the research on the technicals, research on the underlying options, and making sure that you also have liquid ideas that you can execute these trades at your on your platform as quickly as possible. And the credit spread report is basically designed to give you only ideas that meet all of these different criteria so that you can find opportunities, analyze them within 30 seconds, and decide whether it's a trade the structure that works for you. So if you look at, I'm going to look at another stock just because I want to look at stock that everyone is generally familiar with. So Roth stores, many of you may have these stores in your local mall. And as you can see, this is a stock that clearly has been in recently a bearish trend, but recently has rallied back up to a resistance level, potentially where the risk to reward is quite favorable, seeking a bearish exposure. And here, as you can see, my max risk versus max reward, $365 potential reward versus $635. So again, a risk to reward ratio that's a little better than 2 to 1, with, in this particular case, about a 62% chance of profit, giving you exactly what expiration date, what strike price, exactly which strategy to pick. And all you have to do is click on the trade button and have everything you need in order to trade this structure in first trade. Now, this preview order button should be filling out your order, but I'll check with the first trade team as to making sure that that feature works. But you should be able to click on that button and have all of the order ticket pre-filled for you so that you can instantly send this off for execution. Okay, so with that, that covers what I wanted to share with you today. I hope that this was helpful in giving you a review of thinking about bearish markets and how to utilize the options play platform that's available to you free of charge in your first trade account to find bearish stocks and also find optimized bearish strategies on stocks utilizing options play. You can use the tool to also find bullish opportunities as well. This is not by any means limited to bearish opportunities, but today we were just talking about in the context of if and when you're bearish, how you can use these tools to find bearish stocks or how you can find bearish opportunities. But you can use the same scans that I'm showing you here today to look for bullish opportunities. If you feel this morning's CPI print opens equity markets back up to new all-time highs and you think that can continue, then I encourage you in that. But for now, to use the same tools I showed you here today to screen for bullish opportunities rather than bearish opportunities. So with that, what I'll do is I'll open this up for Q&A. There is a Q&A section at the bottom of your screen. If you can type your questions into the Q&A section, we will I will answer as many questions as I have time for. I don't understand why options trading has to be so burdensome when it comes to how much money you need to trade based on minimum deposit requirements and how complicated the system is for unsophisticated traders. My question is this: how to make options trading strategy much simpler and much easier to navigate, and how would platform technologies help reduce the barrier to entry for those who want option trades without furiously losing a lot of money? That is a great question, Benjamin. Hopefully, I showed you the options play platform here today that is meant to significantly reduce the barrier to entry for finding an idea, analyzing the idea, and structuring an option strategy where you don't have to lift a finger when it comes to figuring out what strategy makes sense, what expiration dates, what strike prices to choose from. All of the risk metrics are already pre-calculated for you so that you don't have to figure out what are the break-even costs, what's the probability of profit, how much am I risking, how much can I potentially make. It gives you all of those metrics that you can, within 30 seconds, look at an idea and simply trade it. The credit spread opportunity report is a fully self-contained trading system that you can utilize to automate every single step of the options trading experience, finding bullish or bearish opportunities that you're looking for with a single click of your mouse. So hopefully today's session helps you put you on the right path in regards to a technology that helps make your options trading as simple as possible. Do you plan on supporting micro options, 10 stocks per contract, as other brokers do? Miguel, I'm not sure what brokers you're referring to, but there are no option contracts where it's 10 shares per contract. Not yet. I know that there are firms that are working on it actively. They're pretty close, but I'm curious as to where you are seeing firms that are offering 10 shares per contract. If a wizard shows a bullish debit spread, can we convert it to bullish credit spread? Absolutely. The platform is extremely flexible from that perspective. It has both bullish and bearish debit and credit spreads. So, for example, if you're looking at, you were asking if I have a bullish debit call spread, can I convert it to bullish put spread? Yes. So let's say you're bullish on Ross stores, for example, right? And here you have the bullish debit spread. Now, if you want the credit spread, you can just click on this high implied volatility option here. Whoops. This high implied volatility option here on the upper, on the upper right-hand corner here. And when you click on high implied volatility, this will now give you the bull put spread. So yes, you can easily convert your bull call spread into your bull put spread by the click of a mouse. How do you hedge a 500K portfolio in SPY puts? Great question. Let's go to SPY. There's a few ways that you can calculate this fairly easily. So let's say you want to buy some puts on your SPY. Here's where you can do your risk and investment calculator. And if you have, let's say, a $500,000 portfolio, you would want to say, I want to invest. I would put in $500,000. And then what this will calculate for you is how many contracts of puts that you would have to buy in order to offset a $500,000 portfolio. In this particular case, that would be 9 contracts, because a $500,000 portfolio is the equivalent of 947 shares of SPY. That would equate to 9 contracts of SP. Whoops. That would equate to 9 contracts. Whoops. Let me just go back. We said 500,000. Click on calculate. It will calculate the number of contracts that you would need in order to offset a $500,000 portfolio. And if you want to change your expiration dates, let's say you want to go shorter dated and you want to go out of the money, you can choose all of that and recalculate for you based on your new strikes and expiration, and it will calculate for you the right number of contracts to trade. You're talking about options on futures, which are different than equity options. That's a completely different asset class than equities. How might we use a strategy checklist to screen the options play suggestions? So the question is, how would you use a strategy checklist, right? The strategy checklist is meant to help keep you stay on is to help you make you aware of different risks that you may not have considered when you're trading options. So first of all, we want to make sure that you understand you're trading against the trend of the current market, right? That's why the stock and market trend is kind of showing you red, meaning markets are clearly in a bullish trend at the moment. It doesn't mean that you can't trade a bearish trade. Sometimes the best bearish trades happen when the markets are bullish, meaning that's when you're getting ready for that turn. But it's important for you to understand the risks with doing that. That's part of what the strategy checklist is designed to do. It also looks at the options play score, meaning the risk to reward of the option strategy that you've structured. Right now I've just picked some random strike prices, so the options play score doesn't mean so much. But let's say if I go back to this, let's say I use this put spread and you see the options play score of 143 with the green check marks, that's telling me that the options play score is quite good. I also want to check for earnings date because SPY is an ETF and there are no earnings. I'm good there. And then lastly, spread and liquidity. How liquid are the options that I'm trading? So these are things that you should just be generally aware of before you place any trade. And that's what the strategy checklist will do for you. Any other questions? And just to kind of answer that question about the mini options, just keep in mind that those mini options are only for the S&P and NASDAQ. I'm sorry, they also have Russell and Dow Jones, but it's only for the indices. It's not for the individual equities. And you have to remember, these are for the full futures contracts, which are very, very large contracts. So if you think about the full S&P futures contract, that's a $500,000 position futures contract to begin with. These are large contracts to begin with. So even though you're trading a mini option on the futures contracts, those are the equivalent of trading one SPY contract anyway. So, your 1/10 contract size on ES is roughly the similar size of trading one contract of SPY. So just keep that in mind because we're comparing apples to oranges here. Yes, these recordings are available on the First Trade website. Are there options for other asset classes besides equities like forex or commodities? Yes, but they're traded on different exchanges. So equity options, the thing about ETFs is that you can get exposure to just about every single possible currency, commodities, sector, asset class, bonds. What if you can think it? There's an ETF listed on it. And a lot of those ETFs have options listed on them. So I would say that you don't necessarily need options on Forex or commodities to trade them. You have an ETF listed that tracks those assets and you can trade options on those ETFs. That would probably be the easiest thing for you to do in your equity brokerage account. How long do you normally go back when you look at bullish spreads? Not sure what do you mean by how far I go back to look at bullish spreads. If you don't mind clarifying, that would help me answer that question. Any other questions before we sign off for today? If there are no other in the market data, I'm still not sure. I'm not sure I understand the question, because what does looking at historical market data have to do with looking at bullish spreads? If you buy SUI puts, what is the optimal time? I would say 60 days is as far out as I would go in terms of buying spreads. I would even look at closer to 30 days many times, because unless you're hedging against a big downside that you're expecting, if you think the markets are going to crash, you look potentially at a longer dated option. But if you're just trying to hedge against, a 5 to 10% pullback, and you're think about your average pullback is about 13%, right? Those typically happen in the span of a month or two. So you generally don't need more than 30 to 60 days for those normal pullbacks, if you will, of the market. Okay, with that, that covers what I wanted to share with you here today. I hope that this was helpful in giving you a better understanding of navigating bearish option strategies or bearish markets. Please make sure that you take the time to understand some of these concepts that I showed you before you execute your trades, especially when it comes to options. If you're starting out, make sure you take the time and review kind of some of these strategies. Make sure you understand how to utilize the options platform before you go and execute your first trade. Thank you so much, and I hope you guys have a great trading day, and I'll see you guys here next Tuesday on our next market outlook session.